Mine, I think a risk that I'd say the traditional risk lens is a good starting point there. So if we look at I guess some of the more traditional risk classes to start off with, credit is a good place to start. So, who's the issuer? Let's maybe for purposes of this focus on the debt markets, which is the largest and most liquid part of investing in these markets for investors. So the issuer risk, I think, to start off with. So the credit component is meaningful, and at the sovereign level, clearly you'd be thinking about debt serviceability, debt to GDP ratios as a starting point.
Yeah.
Then, in addition to that, you'll think around liquidity. So the size that I want to bring in and out of this market, what is the market impact of that sort of a size? So what is the embedded liquidity in that market? And even that, to your point, changes and fluctuates over time. It oscillates.
Absolutely.
And then I think a further lens, which is quite important, is what we call T&C risk, transferability and convertibility risk.
Okay.
So now that your investment has matured, or you need to deploy that money somewhere else as an investor, to the extent that you were in local currency, is there sufficient hard currency liquidity for you to convert that matured investment into? And, are there any regulatory restrictions of transferring that out? So T&C risk. I think those are, in addition to, one would always think around, political risk, regulatory stability and framework, some of these. But I'd say they are conditions that come after that in terms of a more holistic picture of the traditional risk lenses to start off with.